When it comes to investing in the market, there are a lot of different options. And in today's video, we're going to look at the two favorite ones that I have. The first one up is lump sum investing. And the second one is the dollar cost averaging, which I love the strategy of doing. We're going to take a look at the portfolio as we continue our 100K challenge, getting up to that 100,000 mark. Like Charlie Munger has said, guys, it is really a B to get that. But when you get up to that 100,000 mark, that is really the milestone. And that is the game changing when it comes to that investment portfolio. So again, the two we're going to look at, guys, starting with the lump sum investing. Now, this has its advantages and its disadvantages. What lump sum investing is, you get an inheritance, you get a tax refund, you get a larger lump sum of money, and you want to invest it into your portfolio. Now, breaking it into, of course, diversification, a couple different strategies, but it is taking all of the money that you're looking to invest and putting it all into the market at one single time and one single shot. Now, this, of course, can come with some pros and cons. Now, looking at it, like let's say you got 50,000 as an inheritance, you take that 50,000, you put it into your portfolio all at once. And of course, immediately, the advantage and the disadvantage is kind of the both, guys. If you put your $50,000 in the market and the market starts to decline, your 50,000 goes to 48, goes to 47, goes to 45. Emotionally, a lot of people are going to have a huge issue with it, saying that it is a bad time to invest. All of my money is gone. I've lost $5,000. I'm pulling it out before I lose more. Investing is a long-term game, guys. What we say with investing, 3 to 5 years minimum. That is right. Minimum when it comes to the investment, you're putting your money in there 3 to 5 years is what you're looking to gain out of this investment. Now, on the other side, of course, this can also be an advantage. You put your 50,000 in there, then it goes to 51, 52, 55. Boom, you made a lot of money in the market on a very, very short amount of time. Because again, there is kind of the advantage and the disadvantage of putting the money in. Now, also with the disadvantage is the emotional aspect, guys. This is where you really have to check your emotions right after a larger investment or putting money in. The emotional aspect can take hold, meaning that you made 5,000, you want to pull the money out, you want to sell it now, you want to get rid of it because you already made $5,000. And for some people, that is an incredible amount of money. But in the same market, guys, like I had said, 3 to 5 years at a minimum is what you're thinking for investment. Markets are going to go up, markets are going to go down. The length or the time in the market is what we're looking to do. Now, my favorite one, dollar cost averaging, guys. Now, again, thinking in that same scenario, let's say you have that $50,000. You want to invest it over the market. Instead of doing it all at once, just pushing that $50,000 in, we are going to break it into essentially a systematic plan. 3 months, 6 months, 12 months, whatever it may be, guys. So let's say, for instance, you take your $50,000 and you want to put it into the investment, or you want to invest it over essentially the next 12 months. We can break it down in a multitude of ways, investing a couple $1,000s in set increments. We can break it down if you want to do it on a weekly basis, if you want to do it on a monthly basis, quarterly basis, whatever it may be, guys. Dollar cost averaging in can really have some big benefits. Dollar cost average, of course, making your own plan and sticking to it. That is exactly what we have done here, guys, with the portfolio. I'm going to show you in a minute. We are 10 weeks in as of right now. Really takes the emotion, and honestly, putting money in there if the market's up, putting money in there if the market's down. If the market is up, great, it is what it is. If the market's down, I'm buying at a discount. I'm super happy to go ahead and put in there. Now, of course, the big part with this for another advantage is the affordability aspect, guys, where realistically, when you look at a person, $50,000 might come around once in a lifetime, maybe more depending on who you are. But overall, when you look at being able to incrementally put money into the market, this is the exact same kind of methodology that people use with the 401k. If I put 15% of my paycheck into my 401k every 2 weeks, that is dollar cost averaging, guys. You might not realize it, or you might not think of it that way, but every 2 weeks, I am scheduling a buy within my stock portfolio or your ETFs, whatever you're investing in. And essentially, you are growing that portfolio through dollar cost averaging every 2 weeks, and we know it works incredibly well. Now, some of the disadvantages to this is the opportunity cost, guys, because if you're putting money in there, your money, of course, is not fully invested because, again, we're not investing that $50,000. We might be doing $2,000 a month. We might be doing, whatever it may be, kind of scaled out to make that $50,000 investment over the next year. Now, if we have a stellar year like 2023, where the market's up 23, 25%, depending on your portfolio, you could be missing out on a lot of opportunities as you're looking to invest money with a portfolio. But the advantage is if the market is down, you're buying it as it goes down like we did, which can again make it very, very viable to have a lot of money in there for the portfolio itself. So guys, let's hop over. I'm going to take a look at my dollar cost averaging portfolio that we've really been working with. So let's go ahead and we will swap this over. And of course, guys, this is through M1 Finance. That is who I use for all of my investment accounts. You can see current value is 84K, so we need 16 more. That is right, guys, at least 16 weeks. We already actually have our buy rate here, which is going to put our current value just a little over 85, which will give us 15 weeks through dollar cost averaging. So what we've been doing with our portfolio is every single week we have been investing $1,000. Right now, I believe we are 10 weeks in at this point. And you can see over the past 2 years, we are almost at a 45% gain. Now, you'll also notice this portfolio we changed up. We were talking about the rebalancing. Now, essentially rebalancing, I do not really agree with the rebalance option, which you can see right here, guys, unless you're doing a fundamental portfolio change, because essentially with the rebalancing aspect, what you're doing is selling off your stocks, your bonds, your ETFs, whatever it may be, that are performing incredibly well to supplement or buy the underperforming stocks or bonds or ETFs that you have in your portfolio. So you're kind of going in there and rebalancing automatically. And a lot of places do this on a quarterly basis, an annual basis, semi-annual. There are regular intervals where you can actually have the rebalancing set. Now in this portfolio for the last 2+ years, I have not rebalanced it. And again, I do not rebalance these at all, because if I have something like the VOO or the VUG that is really overperforming, I'm literally just going to let it run, hoping the rest of my shares and the rest of my stocks kind of catch up. Now, the unique thing here with M1, guys, is you can see we have our $1,000 buy, which I'm going to show you guys in just a minute. But you can see overall, we've put about 74 into this already. We've earned over $1,000, which was just last year with our dividends. But looking at the rebalancing aspect, this portfolio will rebalance automatically. Now, the reason the reason for that, you can see we have 5 buys right here. Looking at the details though, it will buy anything that is underperforming. And of course, right here, guys, is our Grayscale Bitcoin Trust. That is right. This is the underperforming asset that we'll look at in just a minute. And this was the reason why I rebalanced, because we actually wanted the exposure to Bitcoin through this ETF right here is the Bitcoin Trust. This Grayscale Bitcoin Trust is actually converting to an ETF. So that is going to be available. Now, I believe fundamentally the cost basis of it is still pretty high. I think it was at 1.5%. So we'll possibly look at some other ones. But right now, this was the only one that I've seen available through M1. Now, you'll also notice, guys, that the rest of the portfolio remained the same. We took all of these down to that 23%. And then, of course, we did put 8% is where we kind of landed looking at the Bitcoin. So out of this portfolio, guys, even when we hit our $100,000 mark, 8,000 is going to be allocated or set aside for this Bitcoin Trust. And as we continue to go through here and really build it out, we'll get and buy more exposure to the cryptocurrency. And I really think, fundamentally to have a little bit of exposure, most people would say 3 to 4% is really the cap versus buying Bitcoin itself. I'm going to hold on to this trust because we know the ETFs were approved through a bunch of different companies. Over time, there's going to be a lot of money flowing into Bitcoin to essentially these companies to hold the Bitcoin for the ETFs. Now, you also notice, guys, VUG is up 43%. We have the VOO up 44%. These are even up quite a bit, guys. QQQM up 7%. We have the SCHD up 6% since we bought this. Now, the way that we did this, or essentially through dollar cost averaging, is we have been slowly putting money into this, again, like I had said, every single week, tracking the performance and seeing exactly how well it does. And we rebalanced this when we added the Grayscale Bitcoin Trust. And again, that is kind of the reason or the time that I would rebalance. Short of that, guys, short of actually changing up the slices, and that is what M1 does call them, changing up these slices, we are going to keep this consistent. This is going to stay the exact same. Hopefully, again, the Bitcoin Trust is going to go ahead and do a lot better. Now, looking here, again, the timing isn't going to make a big difference, and it doesn't make a difference. But when you look at the historic kind of performance of this, guys, It's kind of crazy if this loads up. So looking at where it is in a day, but when you get into a week, boom, we're up 5%. A month, we're up 15. You go back 3 months, it's up 90%. 6 months, you're at 95%. Or excuse me, well, no, that went back to a day. Looking at a year, boom, up 300%. That is right, guys. BTC is up, I think even more than that for Bitcoin itself, but the Grayscale Bitcoin Trust in 1 year is up 300%. Is it a bad time to buy? Absolutely not, guys. And the reason why I really look at it that way is because of the approval of the Bitcoin ETFs. That's really one of the driving forces. Again, I'm going to go ahead and buy this. We're going to stock up on it every single purchase. So essentially, like I was saying though, it is going to rebalance this portfolio every single time based on my allocation targets over here. So if the VUG goes to 44 or goes to 24, goes to 25, it will put a lot more money into my underperforming percentages. And that is why, guys, we see a much higher investment into this Bitcoin trust because it will even out. So this portfolio through M1, it actually auto rebalances as it goes through here. So you don't have to buy and sell assets, things of that nature, because it will auto balance with the dollar cost averaging that we're doing through here and really the performance that we're seeing. Now I'm going to hop over, guys. I know we missed a little bit, but a lot of people were actually looking for this. So this is when we did our 8K, which was the new year. And then of course, last week, this is where we are as of the buy tomorrow. So we have 9,000 invested, 1,000 that is on the docket. Return is at 44.8. So you can see, guys, went down quite a bit over the last couple of weeks. I'm going into 2024, which I just have to update some of this data, but cash flow will be, I think, about the same coming tomorrow. Looking at the build, and again, market gain, we're at just about even. So last 2 weeks, we actually seen quite a bit of decline here. Looking at the balance, getting up to 84, but here we are down 318. Here we are down 745, guys. So week over week, a pretty big decline in the portfolio. And then of course, some of that is caught right there with the Bitcoin, Grayscale Bitcoin ETF that is going down a little bit. But again, this is the long term, guys. We're looking at 10 weeks in. When we get to 52 weeks, I want to see exactly what this portfolio looks like as we continue to put money in here and seeing exactly what 52 in here, 52K is going to look like once we do hit that point. Or when we get to that $100,000 invested, we might have to reevaluate exactly where we're going to go in the direction of the portfolio. All right, guys, so that is going to do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching.